What is up, world? It's your boy Ton, and you are listening to the Wonton Wealth Podcast. Here, I'm going to unravel anything and everything commercial real estate related. And more importantly, we're going to add abundant value. So if you're ready, buckle up your eardrums. How do we buy real estate? Well, if you have the cash on hand, that's one way. But for most of us, we're going to need a little help from our friends at the bank. So today, we're going to be looking at the various types of loans that are available. And this should give you a good running start. The first type of loan that we have are your conventional loans. So this is your typical mortgage that you're going to get from the bank. You know, your general down payment, which is anywhere from 10 to 30%, and then the bank finance the rest. What I'd like to discuss is the interest-only loans, or IO loans. These are pretty awesome if you're looking to maximize your cash flow. Think of them as like a delayed payment plan. Instead of paying off your principal and interest every month like a conventional loan, you're going to be paying only the interest on the loan for a pre-specified amount of time. So once again, you're going to be only paying the interest on the loan for a set period. That's typically 1, maybe 5, maybe 7 years. And after this period, you're going to be expected to make a balloon payment or switch to a loan where you're going to be paying the principal and interest. So back to a conventional loan after your interest only period. You're probably wondering, why would I ever use an interest only loan? Well, once again, you use them when you're trying to maximize your cash flow. And 2, they're great if you're expecting a big payout in the future and you need some time in order to gather funds or stabilize a property or do something with the operations so that you're not forking out so much money every month. Once again, it helps you maximize the cash flow in the short term. So let's go over an example. Let's say you're buying an office complex with a 10-year loan and you get a 1-year interest-only period where the interest rate is going to be 4%. So let's say the principal on the loan is $300,000. So for the first year, you're going to be only paying $1,000 a month in interest. After that 12-month period, your payments are going to jump up to roughly $3,300 a month, which covers both the principal and the interest. Another type of loan out there are lines of credit. This is a super handy tool. It's like having a financial safety net. You're going to get access to a certain amount of money, which is equivalent to your credit limit, whenever you need it. You get to borrow what you need, you can pay it back whenever, and you borrow it again after you pay it back. And when I say pay it back whenever, that is usually a monthly payment specified by the line of credit's terms. In lines of credits, you're going to have a few different ones here. The first up is what everybody is familiar with. These are called the revolving lines of credit. It typically works like a credit card. The credit card or the line of credit is going to give you a pre-specified amount to use, let's say $25,000. You can use that credit and you're going to have to repay it on a monthly basis. And then once you repay it, you can still borrow from that amount again. So let's say if you have a line of credit for $25,000 and you go out and use the $25,000 immediately, you're going to have monthly payments on that $25,000 for whatever the interest rate is. Usually they follow prime. So let's say it's at 8.5%. So whatever that interest rate payment amount comes out to be, those are going to be your monthly payments for that line of credit. So let's say you pay off that $25,000 by next month, right? So now your credit line is full again. You can still go out and reuse that credit line of $25,000. Secondly, you also have a term line of credit, which is a line of credit that has a fixed period, and you can only borrow and repay within that timeline. After the term ends, you can't use it anymore. In addition, you also have 2 types of line of credits, those being secured and unsecured. If you have a secured line of credit, this means that the line of credit has to have collateral against it, like a property, which the most familiar or the most popular one are home equity lines of credit, which are HELOCs. And then you have unsecured line of credits, which means that you don't need any collateral for use of that line of credit, but you're going to see yourself facing higher fees and interest rates. Next up, we have bridge loans, and these are also known as gap financing. So you want to think of these as a financial bridge for your short-term needs, typically 1, maybe 2 years, maybe 3 to 5 at the most. But typically you're going to see them shorter, once again, the 1 to 2 years. So what do bridge loans do? They actually help you buy a new property before selling an old one. They provide funds for a down payment on a new property when you don't have that capital available when you're figuring out how to sell your existing property. Or they can help you with funding renovations to increase a property's value before you sell it. Or they could cover the gap between you buying a new property and getting a long-term mortgage. The catch with these is that they're going to be higher interest rates. So historically, I've seen them anywhere from 8 to 12%. They're probably higher now, and you're probably also going to see higher loan fees, somewhere between 2 to 4%, because they are short-term in nature and the risk with these are a little bit higher. Bridge loans are great for acquiring a property that does not immediately generate positive cash flow, and they're useful when you don't qualify for a high-quality permanent loan just yet. So here's an example. Imagine you want to buy a new property for $1 million, but you have all this equity in another property that you haven't sold yet, which is also valued at $1 million. And you are looking to get a bridge loan. So to get a bridge loan, they usually tap you out at about 80% of both of those properties' values. So you get a bridge loan for $1.6 million, which is 80% of both of those properties combined, the 1 million plus 1 million for property A and B. 80% of the 2 million comes out to 1.6. Now they give you a check for 1.6 million. You use that loan to buy the new property, and you're going to have a short amount of time to sell that property and then repay the loan. So let's say they give you 6 months. In 6 months, they allow you to sell your old property and then pay off that 1.6 million in total. Then next up, we have private and hard money loans. These are often used interchangeably, but there's a very small difference between the two, and we'll go over that. And these loans are typically from private investors or companies that specialize in hard money loans, and they're not going to be your traditional banks. Typically, they're going to last 1 to 3 years. You can probably stretch for a little bit more, but I haven't seen anything past 3 years. They're going to be higher interest rates. They're going to be higher than your regular mortgages. They're probably going to be, today the prime rate's at 8.5%. I'm seeing interest rates around 12 to 15% for hard money loans, even up to 20 sometimes. The good news about hard money and private money loans is that there's a lot less red tape that you have to cross. You get a lot easier approval rates, and you don't have to deal with all the shenanigans that banks will put you through. They're also collateral based, so they're going to be backed by the property that you're financing. So for some reason, if you default, they're going to be putting a lien on the house or taking out over the house for the payments and or money that you owe them. So the main difference between the private money and hard money is that private money, as the name suggests, is that it's usually coming from friends, family, acquaintances, or business associates, whereas hard money is going to come from professional lenders or companies that specialize in real estate lending. Another term or another type of mortgage or loan that I want you guys to know is second mortgage. These are known as junior liens or subordinate liens, and they are loans taken out on a property that already has an existing mortgage on it. The problem with these is that they increase the risk for the first position lender. If there's a default, you're going to run into some potential for foreclosure complications. One bank's going to want this, the other bank is going to want that. So they get into this little argument of who gets what and where. So it becomes a little bit muddy. Keep in mind though, your primary mortgage note sometimes might prohibit secondary loans, and that can lead to some serious consequences like them calling a due on sale or demanding all the money that you owe them up front. And there you have it. These topics we covered today are pretty much just the basic type of loans that you're going to see out there. In another episode, we're going to cover the other types of loans. So until next time, cheers. And that's a wrap. If you've made it this far, that means you've listened to the entire episode. So thank you. I hope you enjoyed it. And if you did, please leave a review on Spotify, Apple Podcasts, or wherever you're listening from. And if you've learned something or found it useful, share it with one of your homies. And if you want to get in touch with me, I'm pretty active on IG. My handle is pro_TANH. Reach out, let me know what you liked, what you didn't like, or what you want to hear about in the future. I'm here to tailor this to you. Until next time.